Hello and welcome everyone. I'm your host Ajay Aditya C, and this webinar is powered by Zoho Books, our smart online accounting software. In today's webinar, we are going to mainly discuss about the basics of the GST, or the Goods and Services Tax. Some of you here may already be familiar with the GST, while some of you may have heard this term on the news or in an online channel or from a colleague. While there is information available from numerous sources, there are still many questions lingering in our minds about the GST. So we have a lot of questions when it comes to the GST. Questions like, what is GST? Why do we require it over the current taxation system? How do we prepare our businesses for the GST? How to register for the GST? And what are the tax returns to be filed under the GST? And so on. So today, we from Zoho aim to answer at least some of these questions that you have. And as for today's webinar, while I present the content, we have our experts who can answer your questions. So whatever questions you have, kindly post them on the chat and our folks here will give you the answers. Without further ado, let's continue the webinar. So let's start with the indirect tax system that we have in India today. So when we talk about the indirect taxes, we have to start right from the beginning. So let's find out how this came into being. So the very first indirect tax in India was actually implemented by the British. So they brought in what you call as the excise duty, which was levied on manufactured goods. So during that particular point of time, if you take a look at our Indian scenario, the Indian craftsmen were supplying goods for our own masses. But then the British wanted to capture this market. And what better way to capture a market without losing out any profits, because the British products were costlier than our Indian counterparts. And so they levied a hefty excise duty upon the local manufactured goods. And that's how we saw the very first indirect tax upon India. So after that, after the independence, so our government still retained the excise duty because obviously they wanted more revenue, but then they now charged it at a much reasonable rate, and they introduced a custom duty which was imposed upon the imported goods, so that people will now start preferring local products than the foreign products. So with this, let's take a look at the Indian economy, because our economy and the indirect tax system that we have in India, they are interrelated. So let's start by looking at the economy. So we as an economy have grown through the years. And first up, during the time of independence, we were actually dependent more upon the primary sectors in India. So we had agriculture contributing to our GDP during that point of time. So it was the major contributor. And over the years, so the government started investing more upon the secondary sectors, namely the manufacturing and the production sectors. And soon these sectors started contributing more to our GDP. And if you have been paying attention to the Indian economy during the recent decades, say from 1990s, you would have noticed that the service sector is now the major contributor when we talk about the GDP. Because during the 1990s, it was estimated to contribute about 40% to our GDP, and this number has been growing ever since, and now it has reached the 60% bracket. So, with all this knowledge, the government has actually been modifying our tax system to suit with every change that is being occurring within our economy. And they were actually bringing in more taxes, increasing the tax base, and they were creating new legislations to track and govern these taxes with every change and every shift within our economy. Okay, all this sounds good, and this has brought us to such a complicated Indian indirect tax structure. So, if you Take a look at it here. We have a lot of taxes going on, about 17 different indirect taxes levied across different kinds of transactions. So this sounds very detailed, but then what went wrong? The government has been changing the tax system, and it's bringing in new legislation in order to cope up with the changes that are occurring within our economy. It's evolving. Then what went wrong? Why do we need to change from the indirect tax system to something else? Well, the answer to this question actually can be found within the current indirect tax system. So if you take a look at it, there are indirect taxes that are non-uniform across different states. If you take a look at the state VAT, for instance, every state has its own tax rate, and there are certain laws that are specific to certain states, and there are different bodies of tax authorities keeping watch over these taxes and the compliance towards it. So you have a lot of complexity going on with the current system. And then you also have bottlenecks when it comes to interstate trade. So if you are a trader who is trading between states, you have to comply with the rules and regulations of every single state that you pass through. And so you also have certain taxes which are specific to the interstate trade, making your procedure, your transaction more complex. And if that's not all, these bottlenecks have actually forced many businesses, especially if you take a look at the e commerce industry, for instance. Those guys have actually restructured their supply chain from a market centric model to a tax reducing one. And they did it by having warehouses in almost every state between them and their target markets. Even if you take a look at your own purchases online, so you would have bought something on Flipkart or Snapdeal or Shopclues, so you would have noticed that your vendor would be sitting somewhere in Mumbai, and once you procure the goods, they would have dispatched it from their warehouse at Mumbai, and instead of the item directly coming to you, it would actually go through a distribution center in Bangalore, and from there it would come to the sorting facility at Chennai, and then it would be rechecked, and finally the item reaches you. So it goes through certain stages, and it actually is being posed as a transfer between one warehouse to another, and finally the transaction looks as if the item was sold from the Chennai office of the vendor to you. So that's how the system looks like. And all this complication, all these extra steps in the supply chain are mainly due to our complex tax laws. If you take a look at the businesses operating in India, so as we have umpty number of taxes and different rules going on about, every business, if you take on an average, has to make about 33 tax payments a year, and this roughly takes 243 hours worth of attention. So this takes in a lot of time and effort, and some of them have to even go as far as having a dedicated team of employees take care of being compliant with these taxes and getting all those permits and filing those returns. So yeah, and if that's not all, if you take a look at the 2016 World Bank survey, the World Bank conducted this particular survey, and we were ranked 130th among 183 countries when it comes to the ease of doing business. And this is in the year 2016, this year. So we still have long ways to go in order to make our country more easy to do business, because we have these complexities actually barricading businesses. So, with these things in mind, when we raise the question as to what went wrong or why we are going in for a new system, you have your answer here. So, with these things in mind, the government has planned to implement the GST from April 2017 in an attempt to address most of the above mentioned bottlenecks and to improve the ease of doing business in India. And so that brings us to what is GST. When we talk about the GST, the goods and service tax, or the GST, is a single indirect tax that is expected to replace all the currently levied central and state taxes and bring them under one single umbrella. So here the aim is to simplify our tax laws, expand our tax base, and remove the burden of tax cascading that is currently imposed upon the end consumer. So if you take a look at the current module, whatever taxes that you pay when you buy those products, you are actually paying on the whole of the selling price. Whereas after the GST, you just have to pay tax on whatever value was added by your seller on that particular step of the supply chain. Finally, what we specify here is that the GST is built on the concept of value addition. That's how it operates. So how will this be accomplished? Okay, we talk about the GST. We say that it would simplify our tax laws. It will expand, the tax base, and it's going to make it easy with respect to a lot of different things. So how will all this be accomplished? Well, it will be done by converting the whole of India into a single market through uniform taxation and by levying GST only upon value addition. That is how they are going to accomplish this, because previously every state was almost like its own market. Every state was a separate market, and interstate trade was, it's still pretty difficult because we have so many checkposts and so many rules that we have to cross in order to establish that trade. In fact, people even found trading with other countries somewhat simpler than doing interstate trade at times. So in order to remove all of that, by levying a uniform rate across the entirety of India, so they are going to make the whole of India as a single unified market. Sounds simple, but we already have a detailed tax system. So we have a thoroughbred tax system here. So why GST now? The answer to this question can be found in our existing tax regime. When you take a look at the current indirect tax module, it levies close to 17 indirect taxes on goods and services. Okay, 17. So that's too many taxes governed by too many pieces of legislation, which requires businesses operating in India to spend more than 10 complete days of manpower per year to deal with them. So that's the 243 hours that we talked about, which was according to a study done. So that is a lot of manpower and effort going on here. So on top of that, when we talk about the burden of purchase in India, so any product that you buy within India is said to contain about 30 to 35% in taxes. So imagine yourself buying a smart LED TV for say 1 lakh rupees. So in that case, actually, according to the way taxes are being levied, it's quite possible that in that 1 lakh rupees, about 30,000 of it is actually going towards taxes. So the actual value of the TV could be somewhere around 65,000 to 70,000. The amount of taxes that you're paying over there is actually huge. So this is just an example to see how much taxes that you are paying for. On top of that, the interstate trade. Yeah, we were talking about the interstate trade. So it has been pretty complicated due to the CST, the central sales tax, octroi, and other local body taxes. So because of this, the interstate trade is actually being complicated. And a study says that about 40% of the transit time of a truck carrying goods from one state to another is actually spent on the checkposts between the states. So that is saying something. And these things actually have contributed to the formation of the GST. And then we have the problem of tax cascading. So as we already saw, currently the taxes are actually being levied upon the full selling price of a product at every single stage of the supply chain, instead of the value being added at each stage. So yeah, due to these reasons, we need the GST. Now that we know something about why the GST is being implemented, or why it led to this situation, let's discuss how the GST works in comparison to the current tax model. And so yeah, we are going to do this with an example. For this example, I'm going to make a couple of assumptions here. First up, I'm going to assume all the taxes being levied at every stage of the supply chain to be 10%, irrespective of the type of tax. So that is going to be the assumption here. And we are also going to assume the prices to be the same across both the models. So with these two assumptions, we are going to take a look at the example. So let's say you are a wholesaler in Karnataka and you're selling a particular product to a retailer who is also operating in the same state, maybe in Karnataka, for rupees 1,000. So when you make the sale, a VAT of 10% would be applied upon it, and the retailer buys the product for a total of rupees 1,100. So now the retailer adds a value of 1,400, and then he makes the sale to another retailer or a customer across a different state. In that case, for an interstate trade, CST would be applied, CST, octroi, and other taxes. So right now I'm just taking all of them together to be at 10%. And so the end customer or the shopkeeper in a different state is actually paying 2,500 plus 10% of it. So a total of 2,750 rupees to procure the product. So that's how the current tax model is going on. So as you can see, the supply chain is actually being carried out this way. So now we are going to take a look at the same scenario inside the GST model. So when we talk about the GST model, so here inside the GST model, as you can see, right now we have a wholesaler selling it again to the retailer for rupees 1,000. So for a same state transaction, actually, the CGST and the IGST, okay, there are going to be two components of GST coming into place when you're selling to a customer in the same state. So you would have a CGST component and an SGST component. So for that, when it applies to the product, the retailer buys it at 1,100. So far nothing has changed between the indirect tax model and the GST model. When the retailer adds a value of 1,400, making the total final price at 2,500, and sells it to another shopkeeper or a customer across a different state. Now, in this transaction, an IGST or an integrated GST is going to be applied at, say, 10%, not on 2,500, but on the 1,400 or the value added. And so the final price of the product or the final price of purchase for the final customer is going to be 2,640, which is nothing but 2,500 plus 140, so 2,640. So this is how the difference lies with the current indirect tax model and the GST model. So does that mean our goods will become cheaper after the GST? Well, not necessarily. The answer to this question actually lies within the structure of the GST model. So yeah, the GST Council has proposed a dual model giving both the center and the state control over it. And this is done by splitting the GST into two parts. So in the previous example, we saw how the trade happening between a buyer and a seller within the same state has two components of the GST. So if the total GST was something like 10%, then it will have an SGST component or a state GST component and a CGST component or a central GST component. So like 5% and 5%. So yeah, so both the CGST and the SGST would apply to all intrastate transactions. So for same state sales and purchases, you're going to find these two sitting on top of your bill. While the CGST rate will remain uniform throughout the country, is going to remain the same, the SGST counterpart can vary by a plus or minus 1% depending upon the state. So please note that this additional 1% SGST, wherever it applies, will not be available for input tax credit. So that is something to keep in mind. We saw same state transactions. So now we are going to take a look at interstate movement of goods. So in such cases, a combined tax called the IGST will be levied by the central government. So the IGST is also known as the Integrated Goods and Services Tax, and this would actually contain two components, but on the transaction it would just appear as a single tax, and the revenue would be split between the center and the state, though we are not sure on how much the difference would be. Would it be shared equally among the center and state, or will there be a difference? That is something we have to wait and see. So this is how the dual GST model looks like and works. So with that, we come to the tax rates. So we saw the model, and now what are the tax rates under the GST regime? So when we talk about the tax rates, so we have a four-tier tax model being proposed by our GST Council, and this starts with a zero rate, and then you have a lower rate of 5%. We have a standard rate of 12% and an 18%. So you have two brackets of the standard rate, and then you have a higher rate of 28%. When it comes to this, the lower rate or the base rate of 5% will be levied upon goods like edible oil, spices, tea, coffee, etc. And the standard rates of 12% that would be imposed upon products like computers, processed food, and cycles. And the higher end of the standard rate, that is the 18%, will house most of the services as well as items such as soap, shaving razors, etc. So our toiletries are going to be expensive, it seems. And then we have the higher rate of 28%, which would be levied upon demerit goods, goods like SUV, tobacco products, and aerated drinks. So goods like these are going to face the higher rate. And additionally, luxury goods are also going to attract additional cesses on top of the GST. So that is something to keep in mind. And if you talk about gold, after the GST, a tax of 2 to 4% can be seen on gold. Also, about 50% of items from the CPI basket will be exempt under GST. So goods like food grains will be kept zero rated, and majority of the mass consumption items are actually coming under the base rate. So that is actually a very good thing. So the bottom line here is, even though we have the GST, which will unify all the tax rates across the country, different types of products will continue to have different rates. But unlike before, the rates for the most part will remain uniform throughout the country. So that is something to keep in mind. We earlier saw that services would actually be taxed at 18%. So most of the services that we use, be it telecom services, internet, or any form of service that you employ, so all those tariffs are going to go up because of the rise in the tax rate when it comes to services. Okay, so now that you have an idea of what you're up against, let's take a look at how you can prepare your business for the GST. So we just saw earlier about what is GST, why we require it, and how it's different from the current indirect tax model, and the structure and the tax rates under the GST regime. So now it's time to see if you are eligible for the GST. So for this, you have to take a look at your aggregate turnover, because only based on the aggregate turnover of a business, you get to see whether you are eligible for the GST or not. So businesses in Northeast India that have an aggregate turnover of greater than 9 lakh rupees, they have to register for the GST. And if your turnover exceeds 10 lakhs, then in that case, you would have to pay taxes under the GST regime. So that's for Northeast India. For the rest of India, businesses that have an aggregate turnover of 19 lakhs, 19 lakhs, so those businesses are to be registered under the GST. And if your turnover exceeds 20 lakhs, then in that case, you are liable to pay taxes under the GST regime. And state government will also get exclusive control over dealers with revenue of over 1.5 crores. So please keep that in mind. So after confirming your eligibility, we have a few tips that you can use. So work with your current tax accountants and streamline your existing tax returns and transactions. So whatever transactions you have or whatever returns that you need to file, so streamline everything so that it will be easy for you to switch from the current system to the GST once it's ready. And consider strategies for revising the pricing structure of your products and services to suit the GST model. So once the GST comes into being, the current marketing strategies may become obsolete. For instance, it is predicted that right now we have schemes like buy one get one free. So it is said that after the GST, the end consumer will also require to pay taxes on the freebie item coming along. So it would be wise to revise your pricing structure and consider new marketing strategies right now, and upgrade all the technological solutions in use by your organization. For instance, migrating to an online cloud accounting platform would actually ease your transition from the existing tax system to the GST model. The reason behind this is, for starters, the GSTN is going to supply tax APIs that can be utilized by cloud-based apps to sync and update your tax rates in accordance to the changes made by the government. So whatever changes are being implemented by the government, so these APIs or these links between cloud-based apps and the GSTN, the network, is going to allow these systems to get automatically updated. So you don't have to keep tabs on it or make the changes through patches and upgrades. So that is going to be one advantage, and it would also make it very easy to track and match your transactions and file your GST returns online. So by moving to cloud, actually you would be able to map your transactions and directly file the GST returns to your tax authority within a few simple steps. So those are going to be some advantages if you're considering to upgrade your technological solutions in use. So when working towards compliance with the GST, you would also require to register your business for the GST. So as you might have already known, in some states, the registration has already been opened to the public. We have actually attached a handout to this webinar wherein you would be able to see the steps involved with respect to the registration and the dates. So please check the handout for additional information. The registration process would involve the following steps. So, by the way, before we begin this, if you have not already registered for the GST, please find out the enrollment date for your state and register as soon as possible. So coming back to the registration process, so the existing taxpayers. So if you have already registered your business for the state VAT, in that case, you would be receiving an email from the tax authority containing a provisional ID and a password. So for those of you who are not registered with the state VAT, in that case, please contact your tax authority and get started. Coming back to those of you who have registered for the state VAT and have got email from the tax authority, use this provisional ID and password to log in to the GST portal. This would be similar to setting up a new account. So with those provisional ID and password, create new credentials and once again log in to the portal and go through the provisional GST registration process. So here you would have different sections that would appear before you in the interface, and you just have to furnish the complete details of your business across this. Once you do so, you would be given an acknowledgement for the registration, and the government will take about 6 months to process your registration. Once everything is in order and if your registration checks out, you would receive a PAN based 15-digit identification number, also known as the GSTIN. So yeah, keep that safely. So if you're planning to enroll for the GST, you can check out the enrollment plan from the URL that is shown in the screen. You can also take a look at the handout that we have attached to this webinar. Okay, so with that, we are going to take a look at the GST reports or the GST returns. So, depending on the type and volume, businesses have to file different GST returns, and there are totally 11 types of returns under the GST. So, we are going to take a look at it one by one, see what each report signifies. First up, we have the GSTR1. So this is the very first GST return. And here, this return will contain the details of sales or outward supplies for the month. So this particular return is to be filed before 10th of the following month. So if you are filing December returns, so you have to file that before the 10th of January. Next up, we have the GSTR2. So this particular return is actually will contain the purchase details or any details of inward supplies that you have made for this month. And this particular return has to be filed before the 15th of the following month. The GSTR3 is something like a consolidated GST returns for the month, and this has to be filed before the 20th of the following month. So, this particular return would contain the details of your turnover based on local sales, exports. It will also contain details of any TDS transactions that you do. Even though they have dedicated GST returns, you would find some relation to those reports in this particular one. The GSTR4, this is also known as the quarterly GST return, and so this needs to be filed once every 3 months. So we saw some general GST reports. Now we are going to take a look at some specific or special ones. So the GSTR5, this particular report should be filed only by non-resident Indians who do business in India. So those of you who are NRIs, you have to check this out. So the GSTR6, so this particular report is to be filed monthly by input service distributors. For instance, you can take a look at the pizza companies wherein the corporate office actually pays the taxes on behalf of the branch offices. So for cases like those, you would actually have to file the GSTR6. The GSTR7, so this is to be filed by businesses that require tax to be deducted at source. So if you are performing such transactions, say for instance you are hiring a professional and for his or her services you're going to be paying them an amount, and while you make the payment you would also deduct the tax at source so that the professional can show that and receive income tax credit. So for transactions like those, you would need to file the GSTR7, and this has to be done monthly if you deal with such transactions. Then we have the GSTR8. So this is to be filed by e-commerce operators. So if you are selling through multiple channels, not only the traditional means but also online, so in such cases you need to file the GSTR8. So the GSTR9, so we are again back on track with the general report. So this is also known as the annual GST return. So this particular report has to be filed once every single year. Then we have the GSTR10. So this particular return is also known as the final GST return because this has to be filed before a particular business closes down or stops its operation permanently. If any business has to close shop, so in that case, this should be filed by them. Then we have the GSTR11. So this is to be filed by businesses that have a unique identity number, and those businesses that claim taxes based on the purchases or the inward supplies made by them. So when it comes to the GSTR 11, so this would apply to UN bodies and such. So wherein they claim refund for any taxes on purchases or inward supplies. So for those organizations, you would be requiring this particular return. So I would like to summarize everything before we call it a day. So basically today we saw about what is GST. So the goods and services tax is basically a single indirect tax that is going to replace all and subsume all the currently prevalent indirect taxes and bring them under a single umbrella. And when we talked about why we need the GST, that is to remove the presence of tax cascading prevalent within the current system, and to also unify India together as a single market. After that, we saw a bit about the eligibility and the registration process. And anyway, when it comes to the four-tier tax model, we have four different rates. We have a zero rate, a base rate of 5%. We have a standard rate of 12%, as well as an 18% standard rate, and then we have a 28% higher rate. So we saw those tax rates, and we also saw an example on how this will be applied. So with that, we actually come to the end of the webinar. So if there are any questions or any particular scenario that you wish to discuss with us, please feel free to write to us or reach out to us by writing to support@zohobooks.com, and we'll be very happy to discuss with you and have your views on board. So I would not like to keep you any longer than necessary, because the new year is around the corner, and we from Zoho actually wish you all a very happy new year, and a very successful 2017. Thank you so much.